Welcome back to Revenue RX, the podcast at the intersection of pharmacy and finance. I'm your host, Lubna Mazen. It's June 1st, and you know what time it is. Depending on your organization, this time of the year means two very different things. For some health systems, July marks the beginning of a brand new fiscal year. For others, this is the halfway point. That makes June a really important month and a transition period across healthcare finance and operations. Some organizations are finalizing budgets, resetting fiscal targets, evaluating staffing plans, and preparing for new operational priorities, while others are reviewing year-to-date financial performance, reassessing forecasts, identifying reimbursement gaps, and trying to determine whether they are on track operationally and financially. Regardless of where you are in the fiscal calendar, this is the time of year pharmacy revenue cycle leaders should be performing comprehensive operational and financial health checks. Before we know it, we will be at the end of 2026, and the second half of the year will only move faster than the first half. Budget pressures will increase, payer scrutiny will increase, CMS quarterly updates will continue to happen, and small operational issues that went unnoticed earlier in the year will become major financial problems in quarter four if not addressed now. So today's episode is practical. We're going to review a handful of different reports you can run right now before July 1st. Think of this as your pharmacy revenue cycle mid-year checklist. Before diving into operational details, organizations should review overall financial performance. Run reports that evaluate gross revenue, net revenue, reimbursement trends, denial write-offs, contractual adjustments, and medication margin performance. Then compare the current performance against budget, forecast, and prior year trends. Ask yourself, are my reimbursement assumptions still accurate? Are margins tightening? Which service lines are underperforming? Which therapies are creating the most financial pressure? Many financial assumptions made earlier in the year may no longer reflect operational reality, especially with mid-year drug pricing increases, changes in ASP reimbursement, payer policy updates, new medications entering the market, and increasing site of care restrictions. Let's get into the details. Ideally, these reports should be run much more frequently, but we all need to start somewhere. The first report you should run is a denials report. Every pharmacy revenue cycle team should know their highest denied HCPCS code by number of denials, highest drug denials by dollar value, top denial categories, and highest risk payers. You should be able to answer these questions within a few minutes. If you can't, set aside some time to request a dashboard or learn how to build one yourself. Self-reporting tools are amazing and should be used regularly. Looking further into your data, you should categorize your denials into the following: authorization denials, coding denials, medical necessity denials, timely filing issues, and payer-specific trends. Then stratify the findings by area. Start with the infusion center, break it down by clinics, departments, and therapeutic classes. This second report you should definitely be running much more frequently or have built-in systems such as daily work queues to avoid timely filing issues. Let's run a no-charge report. And while we're at it, let's also assess missing charges or unreconciled dispenses. We're going to review encounters with medication administration but no associated charge, infusion encounters that are missing administration or medication charges, replacement dose activities, and high purchase volume medications that have an unexpectedly low charging frequency. Don't forget to compare medication dispense data, administration, documentation, and final claims output. We've talked about this on previous episodes, but charge capture failures are often silent. There's no denial, no escalation, and no payer complaints. You will just be missing the revenue. And many organizations do not identify these issues until later months. So it's really important to have a frequent check-in with these reports. The third report is an underpayment analysis. Unfortunately, for many organizations, this will be a manual assessment. So start with an 80-20 analysis because anything is better than nothing. Go line by line and assess expected reimbursement, actual reimbursement, payer contract terms, ASP plus calculations, and stop loss payments. Have a special focus on outpatient infusion, clinic administered meds, and high cost therapies. This is a great area to involve pharmacy interns. It's summer break and you may have extra interns on hand. So having them participate in pharmacy revenue cycle is not only a great opportunity for them to learn, it also allows you to assess these reports at a much faster pace. The fourth report is a prior authorization performance analysis. Prior authorization assessments should go beyond the approval rates. Organizations should evaluate authorization turnaround times, retro authorization frequency, therapy delays, appeal rates, peer-to-peer escalation trends, and expiration-related denials. Then assess where workflows remain manual, which payers create the most administrative burden, and where staff spend the majority of their time doing rework. Operational inefficiencies eventually become labor costs, and labor costs become financial pressures. The last assessment is a what's aging assessment. Review what's aging in your accounts receivable, specifically in your retail and specialty pharmacies. Review any unresolved claim edits, work queue volumes, and high-dollar unpaid claims. Whether your organization is entering a new fiscal year or reaching the halfway point of the current one, this is a critical assessment period for pharmacy revenue cycle operations. It's time to evaluate financial performance, reimbursement trends, operational sustainability, workflow efficiencies, and operational readiness for the second half of 2026. The organizations that perform best financially are usually not the ones that are reacting the fastest. They're the ones that are identifying risk the earliest. They're the ones running the right reports and asking the right questions. Healing patients is the mission. Protecting the margin is the strategy. This is Revenue RX. As a reminder, this podcast is intended for informational and educational purposes only. The views expressed are my own and do not represent those of my employer or any affiliated organization. This content does not constitute as legal, financial, or reimbursement advice. As always, consult your internal compliance, legal, and revenue cycle experts when making operational or strategic decisions.